Investors have been in the throes of tariff policy whiplash, Fed decision and earnings reports. Constant uncertainty keeps it interesting, of course, but uneasy when it comes to managing portfolios. Our next guest is no stranger to navigating these conditions. We're joined now by Charles Sizemore. He is Chief Investment Officer at Sizemore Capital Management. The firm has over $110 million in assets under management. Welcome, Charles, to the show. I want to start, Charles, where you see opportunity right now. We do have some smart folks, Charles, strategists, CIOs. They come on the show and they do see opportunity overseas, specifically in Europe. And it sounds like, Charles, you agree with that call.
Oh, 100%. And it's not that I'm bearish on the U.S. With the tariff, the entire tariff trade war here essentially on pause for the next 90 days. The biggest impediment to the U.S. market going higher has been resolved. But the bigger question, of course, is who is really in the wings waiting to buy the U.S. market? Everybody is already in. Everyone is already overweight, whether you're talking about mom and pop investors all the way to people running multi-billion-dollar pension funds. The U.S. has been their biggest holding, and then specifically U.S. tech. So that has been a crowded trade for a while. After all of the volatility this year, if you're any investor, whether retail, institutional, whatever, you're looking at your portfolio from the top down, you're going to say, okay, well, I don't really have much exposure to Europe right now. I don't have a lot of exposure to emerging markets. Suddenly, it makes sense to reallocate. So even if that rising tide lifts all boats, markets in general are looking good, I think you are likely to continue to see capital floating into Europe and really non-U.S. stocks. Yeah. It is worth noting the Europe, like a broad basket of European stocks. Just take a Vanguard Europe ETF, for example, is up about 17% year to date, whereas the S&P 500 is flat. So I definitely see a longer runway there.
Yeah, and one of the questions, I was talking to Maria Vietnam about this over in Europe. She sits in Europe, about a little bit of the European trade potentially being overplayed because, to your point, we've already had a lot of gains year to date. So are there any specific stocks or sectors that you are looking at that you think still have a little bit more room to run in the Europe trade?
Yeah, sure. But before I get into that, I would say I think it's really untrue that trade's looking long in the tooth. If you look at call it the 2000 to 2007 window, European stocks beat the pants off the S&P 500. And that was a long stretch. We're talking about 7 years there. What we're talking about today is measured in months. But drilling down, what specific sectors look really good? Defense. What's happening there? Europe and the U.S. have really diverged. Their interests are no longer aligned as they were for the Cold War and the decades immediately following. Europe figured out that they're kind of alone in the world right now. If they want to project power, want to project influence, they're going to have to do it themselves. That means they are rearming. Just this week, the various members of NATO were talking about increasing defense spending to up to 5% of GDP. That's a stretch. I don't know that they'll ever get that high, but you are still, regardless, looking at a major investment in defense. And the European countries are going to be more likely to buy that at home. They're more likely to look to their domestic defense contractors as opposed to looking at ours.
And Charles, let's talk gold as well here. Listen, obviously glittered this year. Maybe the U.S.-China trade truce, Charles, just recently, obviously a boost to risk assets, but maybe put a little dent in the metal shine. You still, though, like gold long term. How come?
Sure. Like gold's that multi-purpose hedge. So it's an inflation hedge, of course. Well, the inflation's starting to come down. Inflation's nearly to the Fed's target. It's also a crisis hedge, and we saw it really benefit from that in April, of course, when it looked like the world was ending. Gold did phenomenally well. Well, now all that's at least on pause for the next 90 days. But what else is gold a hedge for? The dollar. It's a hedge for currency risk. And if you are the trade war, the tariff portion of the trade war anyway, it looks like it's on pause indefinitely. You do have the bigger picture, though, of, again, it kind of goes back to the same way that portfolio managers are reallocating their stock portfolios. Central banks and international players are also reassessing their currency risk. You don't have to have them flee the dollar. You just have to have them slightly allocate out of that and diversify across other currencies and gold for that to really move the metal. So I'm still a gold bull. It probably will be for the rest of this year.
And also here, I want to get a check on another stock that I know you're taking a look at here, actually a basket of stocks, and that's the Magnificent Seven, which we have not talked about. I'm curious, how are you thinking about these names? Do you think that there's still longevity in the tech trade?
The issue with the tech trade is, and specifically Mag 7, is that it is the market now. They so completely dominate the S&P 500 that they can't really meaningfully outperform the S&P 500. They are the index now. So the companies are great. They're wildly profitable. The only real criticism is that it's a crowded trade and has been for a while. I don't know anybody that doesn't already own the Mag 7 and already own them in a disproportionately large part of their portfolio. So that's really what it comes down to, is just concentration. That trade is very crowded and has been for years.
Charles, great to see you and have you on the show today. Thank you.